Okay, good evening and welcome back everyone to our Nordic market live analysis session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And what we're going to do today is continue what we discussed here about 4 weeks ago, which is just in giving you an update on the Nordic markets, where we currently sit within the context of equity markets in terms of the rally that we've seen, what metrics that we're paying attention to help us better understand the current rally in the context of the bigger picture, and then talk a little bit about the sectors, the economics, and then dive into some of the trades that we actually put on together 4 weeks ago and see how they've all turned out. It's a great way for us to understand different ideas, understand different option strategies, and see the benefits, the pros and cons of each strategy. And we'll dive into a little further of that in 2 weeks' time. But before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So I'll do a quick review of the options education agenda, the upcoming schedule, what you can expect to learn with our 2-week cadence. We'll do a Nordic market review. We'll take a look at the broader Nordic markets and where they currently sit. I want to review some of the economic indicators, some of our trade ideas, and then do our paper trading review, which is, I think we had about 10 trades from 4 weeks ago, and we really want to see how those 10 trades have panned out, what the benefits of each one, each trade has been, and what the risks are, and review those things with you so that you understand how you can go about evaluating trade setups on your own. And then we'll open this up for Q&A here at the very end. So today we're doing another market outlook, which we do every single 4 weeks. 2 weeks from today, what we're going to do is we're going to talk about tracking a portfolio and paper trading. This is going to be an extension of what we're going to discuss here today. We've shown you how to utilize the paper trading feature here within OptionsPlay, but we're going to do a separate session just on that alone. And then we'll come back 4 weeks later to do another Nordic market outlook, just to make sure that you guys are on track of what's currently going on with the broader markets. Now, if you're on this webinar today, you're automatically registered for all of these future webinars. If you're watching this as a recording, you can sign up for all of these sessions by going to trade.optionsplay.com/OMX. So if you go to that link, you'll be able to register for all of these upcoming events at once. You don't have to do them individually. All you have to do is register once, and you'll be able to have access to all of these sessions. But the primary question that I want to help investors answer from today's session, for those of you that are watching the market outlook session, is, are equity markets in the later stages of a bullish rally, and is it at risk of a pullback? A lot of investors are certainly concerned that equity markets are getting a little too far ahead of itself, that perhaps we're ready for a pullback. So we want to help answer that question, or help you put the current market into the context of the bigger picture. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And what I want to share with you are my technical charts, my economic research, and the strategies that I'm deploying in my portfolio to help you navigate the current market conditions. So let's start off by taking a look at the Stockholm S30 index, which recently pushed to a new all-time high if we look at the daily chart. The weekly chart remains extremely strong here to the upside, clear bullish trend here on the weekly chart. The daily chart, as you can see, considerable slowdown in terms of momentum here over the past couple of months, since we've peaked around here in late April. And the market really has failed to move significantly higher from that. Over the past couple of days, we have managed to break above these highs that were put in late April. But the one thing I want to warn investors is that as we make higher highs in price, momentum has not confirmed these newer highs. This type of negative divergence, while in itself does not mean that the markets are going to sell off. The longer this type of pattern tends to go on for, the more violent a specific sell-off could be, especially if there's an external catalyst event that drives that sell-off, similar to the coronavirus sell-off that we saw prior to February or March of 2020. So those are some of the things that you really want to be aware of as an equity investor, because yes, things are bullish. We're moving to new all-time highs. We're trading above all of the major moving averages. All of the moving averages are still sloping to the upside. These are all bullish signs for the market. But you also want to be careful and understand, in this type of market environment, do you add onto new bullish positions, or do you take this as an opportunity to scale back some of those positions? That's the decision you have to make as an investor. And what we're seeing in the markets is that a lot of internal numbers is the fact that there's exhaustion, and there is signs that these rallies higher here may not have the same momentum as some previous rallies that we've seen here, where there was far stronger momentum, confirmation of the markets moving higher here. And then from here, we basically have seen that markets, while managing to make a higher high, have barely managed to make a higher high on momentum. And those are some of the concerns that I see here with this broader market. And that leads me to believe that these are times to consider to start looking at put protection, start looking at potential hedges for your portfolio, whether you're buying a put on the index, whether you're buying puts on individual stocks. As markets trade near all-time highs, volatility is also significantly cheaper. That allows you to purchase puts at a reduced cost. So when you look at the Stockholm markets, things are not as extended as the Copenhagen market, which, as you can see, very, very strong uptrend. And after a period of rest, which is what we've seen here in Copenhagen from roughly the beginning of the year to about April or so, the market was basically sideways between these two ranges, but it managed to break out higher here. This is really where we have to pay attention to how much higher can this index continue to rally. What's interesting here is that the fact that as we made a higher high in price, momentum also made a higher high. That is confirmation of that bullish trend. But as you can see, momentum is now fairly overbought on both daily and weekly levels. So this is something that you also have to consider. The fact that we are starting to reach overbought conditions, that tends to lead to more sideways markets in a strong bullish trend. And then you typically need to see some type of a pullback or some type of consolidation before it can continue moving higher, similar to what we saw here. This consolidation period before it continues to move higher significantly. But Copenhagen, out of the four major indices within the Nordics, certainly by far the strongest and showing confirmation of these new highs. And then when we look at Helsinki, Helsinki remains on this very strong and steady uptrend. It's what we call more of melting up, if you will. It's not a very strong move higher here, but it is continued to move higher in a very, I would say, orderly fashion. And you can draw some channels here as well. And you can trade the channel basically. As you get near the top of the channel, you look for more of a sideways consolidation. As it gets to the bottom of the channel, you look for more of a bullish opportunity. And right now we are near the top end of that channel. But as you can see on the weekly chart here, the momentum is reaching overbought. It has stayed overbought for quite some time here. That persistence can hold for quite some time. So remember, just because something is overbought is not a good reason to short the markets, because again, things can remain overbought for quite a period of time. So what you want to do in overbought markets is still wait for pullbacks, because those pullbacks are your opportunities to go long in this persistently bullish market that we are in from the Helsinki market. So looking at this trend line, waiting for pullbacks to that trend line to look for bullish opportunities. Right now, we're just not there. We could get there in just a few days, but be careful on timing for these markets. All of these markets are trading near all-time highs. Stockholm, Copenhagen, Helsinki. When you're trading at all-time highs, be careful about adding brand new long positions. Take these opportunities to take profits. Look at potentially buying some put hedges that have a defined amount of risk. And then if things start to accelerate to the downside, you can hold on to those puts. If things kind of just stay steady in this current trend, look for those pullbacks as buying opportunities. And then lastly, looking at Oslo. This is probably, I would say, the weakest of the markets. As you can see over the past month or so, it has failed to really move significantly higher. And especially on those moves higher here, even though it's printed a new high, momentum no longer confirmed those new highs. This is despite oil's rally that we've seen Oslo continue to show this type of exhaustion. This is also concerning to me to see this type of pattern that prices make higher highs, but momentum makes lower highs. That puts this current rally here at risk of a pullback towards perhaps the 100-day moving average, which is the red line that as you can see. But overall, everything is still pointing in this bullish direction. But you can draw channels here on the Oslo index here as well. We're not quite at the top of the channel here, but it does look like it's perhaps ready to pull back to the bottom of the channel. And as long as that bottom of the channel holds, you have a better opportunity, in my opinion, to seek for a long position in these types of markets. So overall, the four markets, very clear bullish trends across all four markets. Copenhagen, the only one that's confirmed the new highs based on momentum. It is clearly the strongest out of the four. The other three, timing wise, not particularly great in terms of establishing new long positions. This is more of a time to look for consolidation. In a consolidation phase, you have quite a few different strategies that you can deploy. You can sell cover calls. If you think that we're in a later stage and we're ready for a bigger pullback, then you can consider buying some put options as well, or put spreads on the overall market. And this way allows you to have a defined risk way of betting for some correction and protecting your portfolio for that correction. But if markets continue to melt up, you don't lose out on the participation of that melt up when you buy a put option, because a put option has limited risk. If the markets keep moving higher, the most you can lose is the premium that you pay for those puts. So that's how I'm currently viewing the current market conditions and how you should think about positioning within these markets. Now, the one thing that is pushing equities continuously higher here has been the significant move we've seen on interest rates over the past few trading periods. The Swedish 10-year yields have been between roughly 30 and 40 and 50 basis points over the past few months, but we recently just had a break below that 30 basis point level back down to 20 basis points. This really could bring yields back down to as low as 10 basis points. That's going to provide a tailwind for Nordic equities. The lower the interest rates, the higher equities can continue to move higher, especially in the higher beta names. But this is one that you really want to watch, because interest rates tend to be what we call mean reverting. So the mean we can certainly see, or what you would call the average, is certainly around this 40 basis point level. But recently we had them move lower here. But interest rates tend to be more mean reverting. So when you have big moves in one direction, they tend to also recorrect back to the mean. So this is one that we really want to pay attention to, because even if the mean is somewhere around 35 basis points, we're still a far ways away from 35 basis points, and we can see a correction back into that 35 basis point level. So interest rates have dropped a little bit here over the past week or so on expectations that the economic recovery, not only in Sweden, but across the Nordics, across Europe, across the US, has looked significantly stronger in the past couple of weeks than perhaps some investors had anticipated. This is part of why we've seen yields fall substantially here over the past couple of weeks. But it can also spell a little bit of trouble in terms of how investors are positioning in this particular market, selling some equities, buying a fixed income bonds that have driven yields lower here. But this is really some of the things that you really have to pay attention to as an equity investor, and understand the relationship between bond yields and equity valuations. When bond yields are low, equity valuations can remain high, remain elevated, and stay that way. But as soon as bond yields start to rise, that's when those elevated valuations start to come back to earth. So depending on where your position where your portfolio is positioned, whether you're in many of these higher beta, higher leverage names, or are you in more, I would say, blue chip, more big cap, more safer quality type companies that are simply less sensitive to interest rates. Depending on your portfolio mix up, you want to make sure you understand what factors are going to affect the value of your portfolio. So especially for those of you in higher beta tech names like Embracer Gaming, Evolution Gaming, these types of stocks, you're going to see more volatility as interest rates move around. So that's something that you really want to pay attention to. But on the economics front, things look fairly strong. Business confidence here in June recently came out another notch higher, about 118 from a previous high of 116.4. So business confidence continues to improve. And another big number that recently came out here are the May retail sales for Sweden. Basically the highest number we've seen since the pandemic, with the exception of January of 2021. So retail sales remains fairly strong. That means consumers are out there spending. When consumers are spending, that is a fairly strong vote of confidence that they believe that the economic picture in the future looks fairly strong. And these are all things that are boosting equity returns. These are things that are boosting corporate earnings. And that's part of why we're continuing to see equities rally to new all-time highs, despite what is relatively rich valuations, what are relatively overbought conditions, and just timing that isn't particularly strong or favorable for investors to continue to take long positions here in equities. But the underlying conditions are there that sets up for further upside here in equities. It's just important to pay attention to the charts from a timing perspective so that you're not adding new positions at all-time highs when they have the biggest risk of a pullback, but to be more patient, wait for those types of pullbacks before looking for long opportunities, especially when markets are near all-time highs. So one of the other things that I want to point investors to is really looking at sector rotation here in Europe. And one of the things that we're seeing in Europe is some of the things that we're seeing here in the US, which is the fact that there's actually a lack of rotation. There isn't a lot of rotation. You have some stocks moving higher here. You have some stocks moving lower here. Some sectors moving lower here, but largely they're just moving up or down, meaning they're not really moving towards the leading or back towards lagging. There's just a lack of rotation. And these types of markets, when you see markets that are lacking rotation, it's not a particularly healthy sign for a market rally. Market rallies should see a healthy amount of rotation, meaning strong sectors will start to weaken a little bit, weaker sectors will start to strengthen a bit, and you have this constant rotation. And that's why we call this a rotation chart, where you have strong stocks that are starting to weaken, weak stocks that are starting to lagging behind sectors that are moving to improving, and then improving stocks back into leading. And when you see a fair amount of healthy rotation in this particular circular portion, that's how you can tell that certain sectors are leading at certain times, certain sectors are behind at certain times, and they constantly change back and forth between the two. When you have certain sectors that just remain lagging and other sectors that just remain leading, that is the sign of an unhealthy market rally. And that's unfortunately what we currently see here. So that's why when you take everything on balance, when you look at where equity markets are trading, you look at the fact that momentum has not confirmed new highs for many of the major indices here in the Nordics, with the exception of Copenhagen, and then you see the lack of rotation here from the different sectors. That doesn't put a lot of confidence, in my opinion, into the current market rally that we're in. But the one thing I want to point out is that despite the lack of confidence that I have, these conditions can continue on for quite some time. So just because we've identified negative divergence, just because we've identified a lack of rotation, that is not a good enough reason to short the markets. It's just that you have to be aware of these conditions and be prepared of what could potentially happen, which is when you see some kind of external catalyst. A year ago, that catalyst was COVID-19. 10 years ago, that was the financial crisis. But some catalyst that drives equity volatility through the roof, those explosions of volatility tend to be exacerbated and made worse when market conditions are not particularly healthy. Now, we're just only a few weeks into this, so I wouldn't say that markets are unhealthy overall, but we're starting to see the indications, the indicators that show us that the market rally that we're in isn't particularly healthy. But just keep that in mind, is that unhealthy markets can stay unhealthy for quite some time and continue to grind higher. So it's just important to understand how these things work and be prepared for it so that you have a better understanding as to how to protect a portfolio as volatility starts to pick up. You want to learn those things now. You don't want to learn those things when you need them, 2 weeks from now or 2 months from now, as the markets are accelerating to the downside and you're panicking and you're trying to figure out what to do. You need to prepare for those markets now. You need to sell cover calls to potentially take profits as stocks reach their all-time highs. You need to start thinking about collecting premium through credit spreads, through cover calls that you can later use to potentially purchase some put options as the market starts to accelerate to the downside. So these are all the things that you can do in this market condition, because the one thing you cannot do is time when the markets are going to top. It could top tomorrow, it could top next week, it could top 2 months from now. There's nothing that you and I can do to time that. As much as we want to do that, it's just not possible. So what you really have to do is make sure that once you identify these market conditions that lead to an unhealthy market, that you start preparing for it using these types of strategies. So with that, what I want to do is I want to revisit some of the trades that we made together on our session 4 weeks ago together, and just to see how they have turned out. Not all of them have turned out well. Some of them turned out better than others, but it's not really important as to how the trades turned out. What's more important is to understand the various strategies and the benefits of each one and the risks of each one, so that you understand next time when you have a specific view on a stock, perhaps which strategy you might want to trade. So 2 weeks ago, what we showed you was a platform that for any strategy that you were interested in, you can simply, let's pull up any stock right now. Let's look at Embracer for 1 second. For any stock that you're looking at, whether you have a bullish or bearish view within OptionsPlay, you can customize an option strategy for it. So whether you want to buy a put option, buy a put spread, or if you want to use a more advanced strategy like selling a call spread, no matter what strategy you wanted to use, you can use our save trade, which allows you to save a trade and allows you to paper trade that particular symbol. So what you do is you click on the blue share arrow of the symbol of the trade that you want to make. Once you click on that, you click on the link here on the right-hand side. And once you do that, all the trades that you save will be inside of your profile and under your shared trade section. So when you click on that, all of the trades that we made on June 9th, which were all of these trades, you can click on the link for each one of these trades and it will bring up that exact trade that you made, and it will show you how that trade has performed since then. So on that day, we made a few trades. We made one on Electrolux, we made one on H&M, we traded one on BILL, and we traded one on SKF. Those are the 4 trades that we made. And for each trade, we made different types of trades just to see. So for Electrolux, which at the time, I believe it was a bullish trade here, we bought a call spread. We bought the 235, 265 call spread. And we also just bought the straight call option. Both of them expired in August. So let's take a look at these 2 trades first. So at the time, this was on June 9th, right? So June 9th, Electrolux was trading around 234 crowns. We had a bullish view here on Electrolux. Whoops. I apologize. On June 9th, June 9th, the Electrolux was trading at 235 crowns. We had a bullish view here on Electrolux. So about 4 weeks later, Electrolux is about 10 crowns higher here or so, at about 245 or so. So the 2 trades that we made we bought the 235, 265 call vertical, and then we also bought just the 235 call option. So those are the two trades that we made. So what we can see here is that the August 20, 235, 265 call spread gained a total of 335 crowns and is now trading at 1,340 crowns. So let's just do a little math here. 1,340 crowns minus the 335 crowns that we made in profit. That means that we initiated this trade for effectively what is 1,000 crowns. And on the 1,000 crowns, we made roughly 335 crowns. So if we do a little math here, 335 divided by 1,005 crowns, that means on this particular trade, when Electrolux went from 235 to 245, we made roughly a 33% profit on 1,000 crown risk on this particular trade. So that just gives you a sense for if I bought a vertical spread and the trade goes in my favor, and perhaps it continues to go in your favor, and you can keep tracking this trade until August 20th when this trade expires. You can keep tracking this and see how the strategy has performed, because it also would have performed well back here, but it then came all the way back down, and now it's back up here. So it could continue to move higher here, and perhaps you're inclined to hold on to this for further gains, but that's your choice as a trader. But what I want to make sure you understand is the difference between buying just a straight call versus buying the call spread. So let's look at the call option here. We bought just the August 235 calls, which are now trading at 1,550 crowns, and we made a total profit of 350 crowns. So let's do a little math here. 1,550 minus 350 crowns in profit. That means I initiated this trade for 1,200 crowns. So when I make 350 crowns on 1,200 crowns, that's a return of 29%, right? So I'm risking 1,200 crowns to make 29% return if I just bought a call option, versus a call spread. I was risking about 1,000 crowns, which is about 200 crowns less, and then I made a 33% return on my trade. The exact same trade. I traded these both at the exact same time. All I did was compare a call option to a call spread. And the difference, as you can see here, is that the call spread risked less capital and gave me a higher return because I put up less capital to trade it, versus the call option gave me a slightly higher risk, but also at the same time a lower return because I had to pay more money to get into that trade. So before I move on, does that make sense to everyone? Please type, please type 1 into the chat window if this makes sense to you, comparing the call option to the call spread. If anyone has any questions, feel free to type them into the chat window, okay? But this is a feature that you can use the next time you're considering a strategy, right? The next time you're considering an idea and you're not sure what strategy should I trade, and you want to paper trade it. You don't want to risk your real money to learn. Use this feature that allows you to paper trade the strategy. You can go into your shared trades and you'll be able to see each one. You can track it day by day and see how each strategy performs. That's how you learn different strategies and understand how they can perform for your portfolio. Okay, now let's look at H&M. H&M, we also had, I believe at the time, a bullish view on H&M on June 9th. And we traded 3 strategies this time. We traded a call vertical. We sold a put vertical. So we bought a debit spread. We sold a credit spread. And then we also just sold a straight put. Okay, so let's take a look at H&M. I'm going to close Electrolux here for now. And let's look at H&M. H&M on June 9th was trading at around 210 crowns. And at the time, we had a bullish view here on H&M. So here's an example of a trade that did not go in the direction that we expected to. We wanted to go higher, but instead, 4 weeks later, the stock is 5 crowns, 5 or 6 crowns lower than what we originally had expected. So let's first take a look at buying the call spread, right? So this is similar to the Electrolux trade that we just talked about, where we bought the 210, 235 call spread. It's now trading at 373 crowns. We've lost 530 crowns. on this particular vertical spread, okay? So let's do this, 373 minus, well, it's really plus because we're minusing a negative number, plus 530 crowns. So originally we entered this trade for 903 crowns, but we lost 530 crowns out of that. 530 divided by 903 means we've lost about 58% of the premium that we've paid on this debit spread. I usually tell investors once you lose about 50% of the premium that you've paid, it's time to get out of the trade and move on to the next trade. This is clearly a trade that has not worked in the directional view that you had expected. The best practice here is to save the other 373 crowns, which is what you're going to collect if you close out this position, and apply that 373 crowns to the next trade rather than continuing to hope that H&M comes back in the next month or so. Okay, does that make sense? Please type 2 into the chat window if that makes sense to you. So here's an example of a trade that did not work out and what we would do with that type of trade. The second trade that we made for H&M is we sold a 210-200 put spread. So instead of buying a debit spread, we sold a credit spread. So in this particular trade, this currently trading at 575 crowns. We've lost 215 crowns. So we originally established this credit spread at a credit of 360 crowns. Now, just so you understand, with the credit spread, the premium that, I'm sorry, the capital that you have to post in order to enter the trade, that's how we typically calculate risk, right? So this is a 10 crown wide credit spread. We collected 3.6 crowns out of the 10 crown credit spread, which means that in order to initiate this trade, you had to post 640 crowns, which is 1,000 crowns minus the 360 that you collected on the premium. So you would have to pay 640 crowns to enter this particular contract. So 215 crowns that you've lost out of the 640 crowns that you had to pay to enter this trade means that you would have lost about 33% of the premium that, or you would have effectively have seen about a 33% loss on this particular trade. Now, the one thing that's interesting about this particular trade is that the break even on this particular trade is about $206 and 206.4 crowns. And right now, H&M closed at 203.25. So you are only about 3 crowns away from the break-even point. So if H&M recovers 2-3 crowns by tomorrow, this is a trade that would be profitable by then. So the credit spread is a fairly forgiving strategy, right? Because on the debit spread, because I paid about 9 crowns for it, my break-even price on that particular trade is about 220. So the stock would have to get back above 220 or so by expiration just for the trade to break even. That's not even to profit. That's just the break even. That's why when a debit spread loses 50% of its premium, your chances of getting back up here by expiration is so low that it doesn't make sense to risk the rest of the 373 crowns to try to wait for that further upside here. Instead, when you sell a put spread here, you do have a lot more wiggle room, right? Because here the trade has basically gone in the opposite direction as I expected. But even if the stock was to just move another 2-3 crowns higher, I'm going to be back into a more profitable position here by expiration. So the put spread here is far more forgiving than the call spread when the trade doesn't quite go in the direction that you expect it to. And one other thing that you can do is just outright selling a put option. This is something that you should only consider if you're interested in buying the stock. So at the time, the stock was around 209 on June 9th. I sold the 205 puts, and right now the stock is just below 205. But because I sold the option 620 plus 100, I originally sold this for 720 crowns. My break-even point's actually down about 198 crowns. So even though that the stock has gone against the direction that I expected to, from 209 to 203, I'm still above my break-even point, which is why, even though I have the direction wrong, I'm still making a profit here on selling the put option versus if I bought the debit spread, if I sold the put debit spread, both of those will have a loss. But if I sold the put, because I'm collecting so much more premium on the put, it is a more forgiving strategy and I am still profitable on this particular trade. Does that make sense to everyone? Please type 3 into the chat window if that makes sense to you. And if you have a question, please, again, type the question and I'll try to answer your questions as I go along. But this is just a small sample of various strategies that you can deploy and how they effectively play out depending on whether you're right or wrong on the directional view. In this particular case on H&M, we were wrong on the directional view, and you can see how the trades played out. So let's close out H&M, and now let's look at Bill. Bill, I believe, were 2 bearish trades on June 9th. We were bearish on this. So we bought a put option, we bought an August put, and then we bought an August put spread. So similar to Electrolux, but just bearish instead of bullish. So let's look at BILL. So on June 9th, this stock was around 167. So far, we are wrong on that directional view, and the market has moved higher from about 167 to 172. So about 5 crowns higher. Not very wrong, but certainly got the direction wrong. Now, if I had bought a put vertical here currently the put vertical is trading at 395 crowns. I've lost 310 crowns out of that. So let's do a little math. 395 plus 310 means I originally established this trade for about 700 crowns, 705 crowns to be exact. So when you lose 310 out of 705, right now you're down roughly 43, 44% of the premium that you've paid. So you're not quite at the trigger point of cutting losses. I would say you're pretty close to it. But if this continues to move higher, your losses will exceed 50%. That would be the time, in my opinion, to cut your losses. If this starts to move lower here, you're going to start to see this reduce in terms of percentage loss, and you could potentially see this regain a loss on the particular trade. But as you can see here on the spread trade, I haven't lost 50% yet. So this is a trade that I can continue to hold if I still believe that this stock is going to move lower. I will say that the trends have changed substantially since we've entered this, because when we entered this trade on June 9th, the trend quality was starting to deteriorate. As you can see here, we went from bullish trends to neutral trends to bearish trends, and we basically thought this was going to continue. But that has not happened. It went straight back into bullish trends, and it's pretty much stayed bullish the whole time. So the thesis of this trend continuing to go lower is not correct, and we've now corrected lower. I would say this is a good time to cut your losses, save the other 395 crowns. You've lost 310 crowns. There's no need to lose the other 395 crowns. Save that 395 crowns for your next trade. Just because you have a max risk does not mean that you can or should lose all of it. On the flip side, if I just bought a put option, as you can see, that put option is now worth 440 crowns, but I've lost 440 crowns, which means that I've lost exactly 50% of the premium that I've paid. So just on that alone, that should be a reason that you exit this trade. You've lost 50%, move on to the next trade. In addition to that, the trend has simply changed, right? At the time, we were bearish on the stock because we had seen a stock at the time. Let's just forward to what June 9th looked like, right? So we had a stock that was bullish. It started to turn sideways and started to turn lower here. And our concern was that this was going to continue moving lower. Now, fast forward 4 weeks later, we see that's not the case. The trend has returned to bullish. It's made a new high, and perhaps it's continuing to make new highs. It's made a lower high, and maybe we think it's going to continue moving higher. It's not a good enough reason to continue to wish that the markets then roll over. I will say that, this could start to roll over here again, but because I bought a put option, I've lost 50%. It's not a good time to continue holding on to it. If I bought the spread, I haven't lost 50%, then I do think I have the option of potentially waiting a little bit longer and seeing if the stock starts to roll over. So that's the difference between a put and a put spread. I tend to find that when I'm buying a put spread, it buys me a little bit more time because the short option offsets some of the decay of the long option, because the long option here, I've already lost 50%. The spread here, I'm only losing about 43%. So I'm buying myself perhaps a few extra days of time to hope to see that this stock perhaps then does roll over and continues to move lower. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. Okay. Let's move on to our last example, SKF. This is another one that I believe we had a bearish view on. And the 3 trades that we made are similar to Bill. We bought the put spread, but we also sold a call vertical or call credit spread. So we're comparing the debit spread to the credit spread to just an outright put option. So let's look at SKF on June 9th. Let's fast forward here on June 9th. So this was June 9th. Basically, you have a stock. Let me zoom out a little bit more here. June 9th. Okay, so close enough. So you had a stock that was, and I remember at the time what I was showing investors was that this was starting to look a bit like a head and shoulders pattern, right? You have a left shoulder, you have a head, and you have a right shoulder, and the view was that this might continue moving lower here to the downside. So fast forward a couple of months, we were initially right. It did continue to move all the way down to our target of 213, but it ended up bouncing back higher here. But I do think perhaps this could continue to move lower here to the downside. So let's look at the 3 trades that we made and how they have performed. So let's first look at the simplest trade, the long put, right? So we bought the August 225 put. Currently, that's trading at about 1,000 crowns, and we've lost 140 crowns off of it. And this comes down to the fact that time premium on a straight option starts to eat into your trade. So it's currently trading at 1,000, but I've lost 140. That means I originally entered this trade at 1,140 crowns. So when I lose 140 out of 1,140 crowns, I'm only down about 12%. Not a bad result, right? The stock didn't really move, it moved in the direction that I expected to, but bounced back a little bit. I'm down 12%. This is something that I can continue to hold, especially if I believe that this trend can continue to move lower here. And so far, everything is still lining up. The stock has made lower highs. It's made lower lows, right? It just continues on this potential downward channel. So I'm down 12%, simply one that I can hold on to. Let's look at the put vertical here. I bought the 225 put, but then I sold the 195 put against it. It's currently worth 890 crowns. I've lost 35 crowns off of it. So 890 plus 35 means I originally established this trade for about 925 crowns. When I've lost 35 crowns out of 925, that means I'm down only about 3.7%. So like I said, the spread buys me a little bit more time. The stock doesn't have to move as far in order for the strategy to be profitable. And as long as I still believe in the thesis of this trade, which based on the current technicals, I still think is a valid trade, this is one that, because I'm only down 3%, is one that I'm inclined to continue to hold on to look for further downside. And then lastly, if I sold a call credit spread, this is really where, a call credit spread, as long as the stock doesn't move substantially higher, even if it just moves sideways, which is what we've seen here, I'm still profitable. So this is a current trade that's only has $170 crowns in premium, where I've already made 200 crowns of the premium. So it's currently trading at 170. I originally established this at 370 crowns of net credit. So my maximum gain on this trade was 370 crowns when I got into the trade. I've now made more than half of it, right? 200 out of 370 is I've already made 54% of the premium that I can potentially make. that is usually a trigger to take profits. So even though the trade didn't go exactly the way I expected to, I'm already reaching my take profit level. I'm collecting 200 crowns in profit for every contract that I've sold, and I can simply move on to the next trade. And chances are, I probably would have been able to take profit when it got down here as well. When it got down to about 212, 213, I probably would have made about 200 crowns by then at that point, and I would have already taken profits down here. You may have also seen enough gain on the put or the put spread, specifically the put spread, when it was down here around 212 or so to have taken profits as well. It's hard for me to tell, but this is part of why it's important for investors who are learning how to trade to, when you're paper trading a strategy, that you look at it on a fairly periodic frequency, meaning look at it every single couple of days, because as the market moves, as you can see here, right, the trade worked out beautifully in just a few days. You didn't have to wait very long before you saw a nice profit on that trade. And maybe that was enough profit for you to simply take profits and move on to the next trade. But if you held on to it for a little longer, you would have gave back some of those profits. So it's important to understand how the dynamics of the trade works from time to time. As trade goes in your favor, how much money you can potentially make. Perhaps at that time you thought that's not enough profit, I'm going to hang on to it. And now you've seen the stock has given most of that back, and you can see how much do I give back in terms of my profits. This is all part of the learning experience, making sure that you understand how trades work when they go in your favor, when they give back, when they go against you. And some trades, even when they go against you, you're still going to be profitable, like that H&M short put that we've made, or SKF in the short credit spread that we sold. We've reached our take profit levels. It's time to move on to the next trade. So this helps you better understand different strategies, comparing them side by side, and just understanding the benefits and the pros and cons, if you will, of each strategy, because there are pros and cons to each strategy. The credit spread, it sounds good here, right? I've made 200 crowns in profit versus the other two strategies I've lost money. But if this stock really started to plummet and went down to 200, 195, you would see that I'm still going to make 200, 250 crowns versus the other two could have made me 1,000 crowns, 1,500 crowns in profits. So there are downsides to some of these strategies here as well. So the more scenarios you can put yourself into and paper trade through, the more you're going to be educated on these strategies and understand when you should use each one. So with that covers what I wanted to share with you here today. And I just want to ask one last time, does everything with SKF make sense to you? Please type 5 into the chat window if that makes sense to you. Everything that I just discussed with you here with SKF, the 3 strategies here. So just a quick reminder, if you want to do exactly what I did here, any strategy that you type in, all you have to do is click on the blue share arrow for any strategy that you're looking at. So whatever symbol you bring up, all you have to do is click on the blue share button. When you click on that, you will have this link here on the right-hand side. Once you click on that link, what it will do is it will save this trade in your profile. All of your saved trades you can find within your profile. Go to your profile, and then they're in your shared trades folder. When you click on your shared trades, all of the trades that you've made are here, like the Embracer one that I just saved, and all of the ones from June 9th that I saved here as well. And you can go back and you can search by symbol. You can just go back to the individual ones. You can click on the share link that will bring it back up in OptionsPlay, but you can also just see an image of the trade. So if you want to remember what trade, how much you got into the trade for, what was the max risk or max reward at the time, what was your break-even point at your entry point, you can do that by clicking on the image button. And then when you're ready to see the live trade, you just click on the share URL link, and that will bring up the trade itself. That you can track and see how the trade has been doing. So with that covers what I wanted to share with you here today. I hope that this gives you a better understanding as to how to utilize our platform, giving you a better understanding as to my views of the broader markets. At this point, what I'll do is I'll open this up for Q&A. If you have any questions, feel free to type your questions into the Q&A section or the chat window, and I'll try to answer as many questions as I have time for here today. Frederick, thank you for your great lectures. Questions, a bit general. When you establish option-based positions, doesn't your broker demand a security amount? Frederick's question is basically, when you establish an options position, does your brokerage firm ask you for margin? The answer to your question, Frederick, is yes. Now, with most strategies that we discussed here today, where a put option, a call option, a debit spread, the amount that you pay for the option is the only amount that your broker is going to require, or what you call the security amount, is what we call margin. But in the credit spread, that is the only time where the premium that you collect is going to be, the margin requirement is going to be more than the premium that you collect. So this example that I gave before on SKF, where we sold the call vertical, at the time, well, let me bring this up here, shared trades, SKF. So at the time, this was the trade that we entered. We sold the July 16th, 225, 235 call vertical. The max risk on the trade at the time was 630 crowns. So your broker would have required you to have 630 crowns in your account to sell a single contract of this particular option. So your broker will calculate buying power for you and show you how much is required, or how much margin is required for you to enter this trade. So if you wanted to sell 2 contracts, you would need 1,260 crowns in margin, even though you're only collecting 370 crowns in premium. So it depends on the position, but whenever you're buying an option, the premium that you pay, that's the only requirement. Whenever you're selling an option, that's when the requirement will typically be larger than the premium that you're collecting. But your broker will show you the requirement on your order ticket. So when you place an order, your order ticket should show you your buying power or your resulting buying power, meaning how much money you have left. And you can, from that, determine how much your broker is requiring. Auntie, thank you so much for joining us this evening. I hope you have a good evening. Any other questions? I see a question. Sigvard, do you need to track the Greeks as well? If so, could that be automated in OptionsPlay? So Sigvard, I will say that generally speaking, you don't have to track the Greeks once you're in a trade, right? The Greeks are generally used for you to establish which strike price to choose, which expiration to choose. But generally speaking, you don't use the Greeks once you're in the trade. I will say that for investors who have a lot of positions, and when I say a lot of positions, I mean if you have 10, 15, 20 open options positions at a time, then you might want to use the Greeks to understand, are you net short the markets? Are you net long the markets? Are you, how much premium are you collecting per day on the options positions that you own? That's the type of information that the Greeks would provide you with. And that is something your brokerage firm should be able to do. And if your broker can't do it, I suggest that you consider finding a broker that does. For example, Interactive Brokers in Sweden, and I think that's the next question from Tommy, is can you recommend a broker for Swedish residents where you can trade many legs with OCO orders? Tommy, the only one in Sweden is going to be Interactive Brokers. They offer all of these different order types. They offer multi-leg trading, and they are also very cost effective. They're relatively inexpensive to trade with. And Sigvard, with Interactive Brokers, you'll be able to track your position Greeks, or what they call portfolio Greeks. So you can see the net delta across all of your positions, or your net theta across all of your positions. That gives you a sense for how much exposure you have and whether you're paying premium every day or if you're collecting premium every day. Any other questions? If there are no other questions, I just want to thank everyone for taking the time out here this evening. I know this is the summer and many of you are taking some vacation time off, so I really appreciate you taking the time here on your evenings to spend time with us to learn more. I hope that this was helpful. We do record these sessions so that you can watch them at any time at your own pace. You can actually see all of our recordings at trade.optionsplay.com/NordicEDU, which I will post into the link into the chat window. This allows you to access all of our courses that we have put together, beginner, intermediate, advanced courses to help you better understand these types of options. Whether you're a beginner, you're an advanced trader, utilizing these courses will help enforce your understanding of options and make sure that as you're trading them, you understand how to leverage them properly for your portfolio. But most importantly, try to use the paper trading feature because it allows you to practice, allows you to try things out without risking real capital. Doing that first, making sure you understand it before you risk your real capital can go a long way in helping you avoid some of the beginner mistakes. So with that, thank you so much. Have a great evening, and I'll see you guys here in 2 weeks' time, where we're going to do actually a full session just on paper trading to give you a better understanding of the features here embedded here. Have a great day and see you guys here in 2 weeks.